Episode 13, Wednesday, April 22nd. Oil had an absolute day yesterday on a supply shock out of Hormuz. We're talking a billion-barrel miss according to Vitol. And yet somehow futures are green this morning because the market's convinced a ceasefire is actually happening, which is a hell of a trick to pull off. We're going to figure out what's real and what's priced for perfection. And then we're parsing the Apple CEO move because apparently Tim Cook decided yesterday was his retirement day. So we've got a whole new regime to think through. It's a two-front show today. Let's go.
Yesterday I watched a pigeon try to intimidate its own reflection in a car door for a full 5 minutes, and I think it won. Yeah, that tracks for today.
That pigeon is basically the oil market right now, fighting its own reflection while the actual supply math is screaming something else. Alex, explain how we are green.
Yeah, so the ceasefire extension. Trump pushed it through overnight, talks are supposedly back on, and the market is reading that as de-escalation. Gold and silver got destroyed yesterday. The gold ETF down nearly 3%, silver down 5%, because traders were already fading the war premium. And then gold is already bouncing pre-market, which means the conviction on that trade lasted about 12 hours. But here is where it gets truly weird. Oil gave back most of yesterday's rip overnight. The oil ETF is down about 1.5% pre-market, even though Vitol went on record saying the market has lost 1 billion barrels of supply. Iranian tankers are routing around the blockade, and Ukraine is apparently restarting flows through a Russian pipeline as a partial offset. So the supply picture is a mess. Nobody agrees on how tight it actually is. Meanwhile, on the equity side, AMD up 3.5%, Microsoft up 1.5%, AI infra bid holding, Apple minus 2.5%, Google minus 1.5%, consumer hardware and ads getting sold. John Ternus is the new Apple CEO as of last night, Tim Cook to executive chair, so that story has legs today. VW is rolling out voice AI in its China fleet this year, which tells you edge AI is moving into autos. And on the commodity side, BHP just wrapped iron ore pricing talks with China's centralized buyer. That matters for steel input costs. The actual tension here is whether the market can price both a ceasefire and a structural billion-barrel hole at the same time. One of those does not work. Tom, the tech split. AMD and Microsoft are not acting like the consumer is in trouble.
Yeah, it is not tech. It is plumbing. AMD and Microsoft are the stuff everything else has to run on, so they get bought when people think the spend is non-optional. Apple and Google are the parts that get cut the second the end customer flinches. You can delay an iPhone. You cannot tell your AI model to just take a quarter off. The market is basically saying the build-out continues, but the monetization layer gets questioned. Ray, does that hold, or are we just dressing up a rotation?
I do not know if it is just a tech split, Tom. Because if you look at yesterday, the utilities and the small caps were getting dragged through the mud right alongside the consumer names. It feels more like an inflation fear rotation to me, where that massive oil spike is finally hitting the footnotes and people realize that energy costs are going to squeeze the life out of anyone with a thin margin or a high debt load. We are seeing the market hedge against a world where the cost of doing business just took a structural leap upward because the plumbing for the whole economy, not just AI, got expensive. Alex, take us into the tape. I want to see if the bond market is actually buying this peace narrative, or if they are still staring at those oil numbers.
So here's the thing. We have got this perfect storm sitting in the data right now. The ceasefire is buying us a bounce in equities and a bid in gold, but oil will not let go of that supply math. And Ray is right that the real risk is what happens to margins across the board if energy costs just ratcheted up structurally. The bond market is going to tell us whether traders actually believe in peace or if they are hedging for stagflation. Let us go to the tape and see what the spreads are doing. All right, so yesterday we got hit with two completely different stories, and the market is basically pretending they're the same thing, which they're not. Let me walk you through the tape. Energy proxies ripped. The oil ETF was up 5.71% yesterday. That's a billion-barrel supply miss, according to Vitol. Iranian tankers routing around the blockade, the whole 9 yards. This morning, the oil ETF is sitting at 126.15, down about 1.5% pre-market. So we're giving back about half the move before the cash even opens. The supply math hasn't changed. The billion barrels are still gone. But somehow the oil market decided overnight that a ceasefire matters more than a hole in global crude, which is either the most bullish thing I've ever seen or the most delusional. On the flip side, gold and silver got absolutely destroyed yesterday. The gold ETF down 2.83, silver down nearly 5. Classic war hedge unwind. And it makes sense, right? If you think the Iran thing is over. Except this morning, gold's already bouncing. We're at 437 on the gold ETF, up 1.77% pre-market. So the conviction on the peace trade lasted about 12 hours. The equity side is where the real split shows up. Rate sensitives slid yesterday. Utilities getting dragged, small caps down 1.02 on the Russell ETF, which tells you the market's worried about what a structural energy shock does to margins and borrowing costs. 10-year moved up 4 basis points overnight to 4.29, 5-year up nearly 6, so the bond market is pricing in some actual inflation pressure here. But tech is bifurcated in a way that matters. AMD up 3.47 yesterday, Microsoft up 1.46, the infrastructure bid is holding. Apple down 2.52, Google down 1.52. And we've got a new Apple CEO as of last night, which is its own story. But the tape yesterday was saying the consumer names and the ad stack are getting sold into any strength. The central tension is this. The ceasefire is bouncing equities and gold this morning, but oil cannot hold a 5.71% rip overnight, even though the supply picture just got worse, not better. And the small caps are lagging because the market's starting to price what happens to leverage and margins if energy costs just took a permanent step up. Tom, the tech bifurcation. AMD and Microsoft acting like the AI build-out is non-optional, but Apple and Google getting sold. What's the market actually saying here?
It's not tech, it's CapEx versus demand. AMD and Microsoft are where the money has to go. Apple and Google are where it has to show up. And that part's getting questioned. If energy is a tax on the consumer, you don't want to own the companies waiting on the consumer to feel rich. Ray, is this just early cycle margin fear, or are we finally admitting the monetization lag is real?
Tom, the 10-year yield at 4.29 is really the tell for me. If this ceasefire were actually believable, you'd expect the bond market to take a breath. But instead, we're seeing yields grind higher. Which tells me the market thinks the inflation tax is structural regardless of the headlines. It makes that monetization lag look like a permanent margin squeeze because the cost of capital just isn't coming down to save those consumer tech names. Alex, close us out on the tape. Is the volume actually backing this move?
Yeah, the volume on the oil unwind was real. We saw clearing on the oil ETF at elevated prints yesterday, but the stall this morning on 0.5% down tells you conviction evaporated overnight. That's the tape screaming that nobody actually believes the supply story got better, they just like the headline. Bonds and oil are having completely different conversations about whether this ceasefire sticks, and equities are pretending to split the difference. The real tell is going to be in the fine print, Iranian tanker routes, what Vitol's actually seeing on the crude curves, whether that Ukraine pipeline stays shut, and what BHP's China bookings look like. That's where the supply math lives. Ray, you want to walk us through the footnotes?
Yeah, Alex, the tape is basically a mood ring right now, but the footnotes, man, the footnotes are where the actual plumbing is leaking. I was looking at the Fred charts yesterday for global crude stocks, and then I saw this Vitol headline. 1 billion barrels erased from supply because of the Iran war. 1 billion? That's not a rounding error. It's like someone just deleted a month of global production from the ledger. And then you have the FT reporting that Iranian tankers are they're just sailing right around the US blockade, like it's a suggestion rather than a sanction. So you've got this massive hole in supply, but then you have this ghost supply from Iran blunting the impact. And then, this is the part that really got me yesterday, Ukraine is restarting flows through the Russian oil pipeline. I had to read that twice. It's this desperate, weird pragmatism where everyone's so starved for liquidity, they're willing to move the enemy's oil just to keep the lights on. When you stack it all up, the oil supply picture is this absolute bird's nest of competing forces. The market sees a ceasefire extension headline and thinks everything is fine, but the physical reality is a durable deficit. That's why the gold ETF is already bouncing this morning, sitting at 437 and up 1.77%. It's basically saying the peace talks are a head fake. If the truce is faltering while it's being extended, gold knows the safety bid isn't actually dead, it was just napping. And then you look at the BHP news. They finally wrapped those months-long iron ore talks with China's centralized buyer. That's the steel side of the story. It means the input costs for the entire industrial base are getting locked in at these elevated levels. It's not just an energy shock anymore. It's becoming a structural cost of doing business shock. I mean, we're all sitting here watching the S&P futures up 0.5%, but the footnotes are basically screaming that the inflation floor just got a lot thicker. Tom, if we're moving from a temporary energy spike to these locked-in high costs for steel and iron, how does the Fed even pretend that 2% inflation is still the target?
They don't really. The toolkit they have was built for people buying too much stuff, not for the world running short of the stuff itself. You raise rates, you slow loans, hiring cools, wages soften. That's how you crush demand. It works if inflation is people bidding up prices. It does nothing if the price is high because the barrel isn't there or the ore contract just reset higher. So what they're actually doing when they hike into this is taxing growth to compensate for a cost base that doesn't move. You're deliberately weakening the part of the system you control to offset the part you don't. And the bond market can feel that difference. 2022 had a demand pulse you could choke off. This has a military floor under it. That's why long yields aren't behaving like inflation solved if we just tighten enough. It's structurally stickier, and policy looks a bit cosmetic against it. This is a supply shock with a passport. Rates don't fix that. Alex, take us into Nerd Corner.
Right, and that's the thing. Ray just mapped out a billion-barrel hole that no rate decision closes. And Tom's saying the Fed's basically hoping the invisible hand does their job for them. That's footnote territory. Real constraints, not dial turning. So we're going to Nerd Corner to look at where the actual leverage lives, not in monetary policy, but in how the tech stack either absorbs or amplifies these cost shocks. Volkswagen embedding voice AI in Chinese EVs, Apple's Ternus era just beginning, these are the supply chain decisions that actually matter when input costs are locked in at new floors. That's where the margin story lives.
Yeah, this is where it stops being AI is cool and starts being where does the dollar actually get captured? Because both of these are device layer decisions, not cloud, not training runs, device. And that's a different map entirely. Start with Volkswagen. Voice AI in Chinese EVs sounds like a feature. It's not. It's a volume commitment. When you put AI on device in a mass-market car, you're saying, this thing has to run inference locally, cheaply, reliably, millions of times a day, across millions of units. No latency, no cloud dependency, no per-query cost. It just works. Every time you say, open the window in traffic, that shifts the semiconductor demand curve in a very specific way. Data center AI is lumpy. Huge GPUs, bought in bursts, tied to CapEx cycles, financed like infrastructure. Edge AI in autos is relentless. It's smaller chips, lower price per unit, but the unit count is insane, and the replacement cycle is tied to car production, not cloud budgets. So instead of who can build the biggest GPU, the question becomes, who can ship tens of millions of efficient inference chips that don't overheat in a dashboard in Guangzhou in August? And China matters here because they don't wait for premium, they standardize fast. If VW is doing this, the local OEMs are already doing it cheaper, tighter, more integrated. So now your baseline car, not your luxury trim, has a neural processing unit sitting next to the infotainment stack. That pulls in memory, power management, sensors. It's a whole bill of materials shift, quietly. And the key thing, inference at the edge doesn't need NVIDIA the same way training does. It needs different silicon. More like Qualcomm, MediaTek, Apple-style integrated silicon, even custom automotive chips. So when people say AI demand, they're mostly pointing at data center revenue. This is a second demand curve forming underneath it. Lower margin per chip, higher certainty of volume. It's boring, which is why it's dangerous to ignore. Now flip to Apple, Ternus, hardware guy. That's not subtle. That's Apple saying, the next leg of value is still in the object you hold, not the service you subscribe to. At least for now. Because if the AI moment had clearly landed in software, if Siri had suddenly become indispensable, if Apple had a services layer AI that printed money, you'd put a services operator in that chair. You don't. You put the guy who builds the thing. Which reads like an admission, quietly, that the AI product they want isn't ready yet. So they're doubling down on the layer they control completely. Silicon, form factor, integration. Apple's advantage has always been, we design the chip, the OS, and the device as one system. In an edge AI world, that matters more, not less. Because inference performance per watt, how much AI you can run without killing battery, becomes the product, not the model size in a data center. And the tape kind of told you people didn't love this yesterday. Apple down 2.5 into the announcement. That's the market going, oh, so we're not getting an AI services re-rating yet. We're getting better hardware, which is valuable, but it's slower. It's iterative. It doesn't get you a multiple expansion overnight. So now connect the two. VW is pushing AI down into cheap, ubiquitous devices. Apple is reorganizing around owning the device layer even harder. Meanwhile, the hyperscalers are signing nuclear power purchase agreements to lock in baseload for training clusters. Oil is a headline. AI is a contract. We said that. Still true. But here's the tension. The entire AI trade has been priced like the cloud layer captures most of the value. Big models, big margins, big multiples. That's the duration trade dressed up as fundamentals. You're paying today for cash flows way out in the future, assuming dominance. Edge AI complicates that. Because it says, actually, a meaningful chunk of value might get trapped at the device level, in silicon efficiency, in integration, in whoever controls the physical endpoint. And those cash flows are nearer term, more cyclical, more tied to units than usage. So you end up with two AI economies running in parallel. Cloud, high margin, capex heavy, long duration, power constrained. Edge, lower margin per unit, insane volume, supply chain constrained, here sooner than people think. And the market is mostly still priced for the first one. Ray, here's the uncomfortable one. If Edge AI scales faster than expected, does that actually cap the upside on the cloud names? Not kill it, but compress it, because the value leaks out to chips and devices instead of staying in the model layer?
Tom, you're describing a massive shift in duration risk. If those cloud margins are 5 years away, but the edge chips are shipping yesterday, the market has to stop treating AI as a long-duration proxy for interest rates and start looking at it like a cyclical manufacturing trade. It completely changes how the sector reacts when the 10-year yield spikes if the cash flow is happening right now in a factory. Alex, are the device guys actually positioned to capture that value, or does it just vanish into the supply chain?
Look, the answer lives in the stack. If you own the full thing, Apple does, VW's trying to, you capture it. Ternus over the software guys tells you Apple thinks that's defensible. But the moment you outsource the chip or the integration, Ray, you're right, it disperses. It becomes a Qualcomm or TSMC or battery supplier problem. VW might not own enough of that chain. So the real bet isn't edge AI wins, it's who owns the edge. And that's narrower than people think. Oil supply shocks, a sticky inflation floor, and now two completely different AI economies competing for the same investor dollar. The framework is clear, the positions aren't. That's what calls is for. All right, so last episode was a complete disaster. All three of us whiffed. Let me score it quick because this is actually important. We're now at a historic level of wrongness that's starting to feel like a reverse signal. Tom, you had the QQQs closing red down about 1%. They did close red, 644.33, but that was only down 0.7. You nailed the direction, which, fine, but you fell short on magnitude. That's a miss. Ray, you called the gold ETF up at least 1%. Gold got absolutely demolished. The gold ETF closed at 429.57, down 3.67. That's the opposite direction and the worst miss of the day. Rough. And my call was the 10-year above 435. It closed at 429. 6 basis points away from being right, which is basically a miss. I was wrong. So I'm sitting at 2 wins, 9 losses. Tom's at 1 and 9. Ray, you're 0 and 8. This is genuinely bad. We're running a reverse signal so pure it's almost beautiful. If this keeps up, we should just start doing the opposite of what we say and we'd be millionaires. But listen, we just came out of Nerd Corner with a tight macro framework. Oil's constrained, there's an inflation floor nobody's shaken, and we've got 2 completely different AI economies. The integrated stack guys versus the software first guys, all fighting for the same dollar. That's the real tension in the market right now. So let's put money where the thinking is. Tom, you're first. What's the call?
The semiconductor ETF closes up at least 2% by Friday. Markets priced for cloud capex only. The edge demand shows up as cyclical, and they chase it late. I'm wrong if crude closes below 75. That kills the inflation floor, and this whole rotation never starts.
0 and 8. I mean, at some point you have to respect the consistency of being this completely mathematically wrong. Tom, I actually love that crude invalidation because if oil drops below 75, the inflation floor we've been talking about just turns into a trap door. But right now, the bond market is refusing to believe the everything is fine narrative. Yields are grinding higher while gold is bouncing pre-market. That tells me the safety bid is shifting from peace is coming to everything is still expensive. So my call. The 10-year closes the week above 4.35%. We're seeing these locked-in input costs for steel and energy that just don't care about a temporary ceasefire. The market is finally pricing in a structural floor, not a temporary spike. I'm wrong if PCE data comes in cool enough to actually let the Fed breathe. That would snap the yield curve back instantly.
Yeah, Ray's got a point on the input costs. Ceasefire or not, you can't unbake the energy and steel into the system. The 10-year above 435 is a real tell. I buy that. Here's mine. West Texas Intermediate closes above $82 a barrel by end of week. Look, Tom just said crude below 75 breaks the whole inflation floor thesis. I'm going the other way. Oil couldn't hold the overnight pop on ceasefire news, came back down, and that tells me the market knows something. We've got 2 narratives fighting. Peace is coming, but input costs are sticky and actual demand is still there. The intermediate view wins. 82 is where we need to close to confirm the supply shock is durable. I'm wrong if WTI closes below $78 by Friday. That would mean the ceasefire narrative actually has legs, and the billion-barrel hole is getting patched. All right, that's the calls. 2 and 9 is ugly, but at least we're putting real stakes on the table now. Thanks for listening to 3 Clowns. Show notes and previous episodes at 3clowns.co. We'll be back tomorrow morning before the open.